Okay, that should be enough time. Let's get started. Welcome to the June 7th edition of the Fats, Fuels, and Oils webinar. This week, we're going to cover vegetable oils and biofuels. I forget exactly where we are in the order, since we kind of have not been on our regular schedule over the last several weeks, at least over the last month, probably. One note on the schedule: June 19th is now a federal holiday, and that falls on a Sunday. So I assume that the markets will be closed on Monday. Typically, we wouldn't have a webinar that week, but I feel like since we have skipped so many webinars over the last several weeks, that we probably should go ahead and have a webinar that week as well. So we will. And the only hiccup there might be that the report might come out after the webinar instead of before the webinar, like it does most of the time. Okay, with that, let's get started. So the big news over the past week, obviously, was the release of the final RFS RVOs, or the RFS mandates. That came out pretty much as expected. The RIN market had run up pretty sharply in anticipation of the changes that the administration made, and those were an addition to the 2021 total mandate that effectively raised the ethanol, the implied ethanol mandate, to a level that was equal to usage, but that still fell short of what production was, and then a cut of the 2022 mandate of about 140 million gallons. I think that was basically a cut in the cellulosic mandate, which is, again, that mandate has been, or the capacity to fulfill that mandate has been problematic. And even with the cut, I think right now we are, we've had 4 months of data, and we're already, the forecast is for, or the mandate is for 630 million gallons in 2022. And I think our forecast for D3 production, which is essentially the cellulosic mandate, is at like 560 million gallons. So even with the cut, it's difficult to reach the number that they're forecasting. That said, we kind of have taken the pace of their forecast and extended it out to 2023, and you can see our 2023 projections for the mandates on the screen. Nothing that is very, at least I don't think the growth rate in any of those categories is not amazing or undoable, bar the D3, which is undoable this year and will probably be undoable for 2023 as well. But I think that's probably close to where they'll set the mandate. Maybe they'll come back and reduce it or keep it flat year over year, so that capacity can catch up. But either way, it's a relatively minor portion of the overall mandate. The interesting thing about the change was that it left the implied ethanol mandate at 15 billion gallons, which, when you add in the 250 million gallon supplemental, still leaves a relatively large gap between what we expect ethanol production to be and what the ethanol mandate is. And that obviously we think will be made up, at least in some part, with biomass-based diesel production. And in the article, I kind of go through the math or in the soybean article, I kind of go through the math of the potential increase in D4 production, and kind of how we calculate it. So traditionally, there is a gap between the advanced mandate and D3 production, D5 production, the biomass-based diesel mandate, and then you also add in Brazilian ethanol imports because they qualify as an advanced biofuel. And so that gap is roughly sorry, I'm just trying to read it here. That gap is roughly 646 million gallons that would be produced, that would be added to the D4 to biomass-based diesel production. And then if you include the ethanol gap, which the ethanol gap is another, basically call it 1 billion gallons in ethanol gallons by the time you convert it back to biomass-based diesel gallons, then you're adding another 200, maybe that's the 646 million gallons. I apologize. If you read the article, it kind of sorts it all out. The bottom line is that our forecast for renewable diesel, biodiesel, and co-processing production is 2.7 billion. Sorry. Today, this is just an example of how today is going. Sorry about this. So our forecast is 3.73 billion gallons for that total. If you add up all of the, if you add the two gaps to the RFS mandate, you come up with 3.97 billion gallons. And that's important because what that really meant is that even though the EPA lowered its 2022 overall mandate by 140 million gallons, we were already sort of shading to the low side anyway. And so we didn't really change our 2022 production forecast based on the reduction. And we still are 300 million gallons or 230 million gallons below what the potential production could be. Now, you could get an increase in imports of renewable diesel. You could get an increase in Brazilian ethanol imports. You could also get more production in other D4 categories or D3 categories or D5 categories. All of those would count towards those gaps and reduce the amount of biomass-based diesel production that is needed to fill those gaps. You also, in theory, could meet the RVOs by drawing down the RIN bank. And so there's not a sort of, if the EPA says this, then this is exactly what it means for biomass-based diesel production. You kind of have to feel your way through it a little bit. And that's why we have built in the buffer that we've built in. That said, we will continue to obviously monitor production on a month-over-month basis, and we'll adjust higher or lower as the monthly data comes in, based in part on the trend that we see this year and the seasonal pattern that we typically see. And so the point of all of this is really that while our forecasts seem relatively high, at least I've gotten some questions about how large our forecast is, there is some cushion built in there, and we could, if we were just pushing it out to the maximum, we could be potentially even higher. I think probably more interesting than that math, because while that math is important in setting sort of boundaries for production, is the split between biodiesel and renewable diesel. And from that perspective, we didn't make any changes, in part because we still think that these gaps leave enough room that there will be support for biodiesel margins. And we might as well just kind of go into this. And so what we've got forecast for biodiesel margins with credits here, you can see through the end of the year is kind of trading around zero. just plus or minus. Now, remember, this does not include the sale of glycerin or any other byproducts from the process. And so profitability probably is a little bit better than this, which suggests that that the biodiesel capacity probably doesn't come down that much, or doesn't come down as much as maybe some people think in 2022. And the recent EIA data, I think, kind of confirms that, where we're not really seeing big reductions from month to month in the EIA reported biodiesel capacity. Now, the EIA biodiesel reported capacity is a huge number relative to what monthly biodiesel production really is. And so on some level, you kind of have to think that maybe some of those plants are being reported as open, but effectively are sort of already closed. But either way, I think that what the gap really does is it kind of supports that, in theory, it supports that margin for biodiesel to keep the biodiesel guys in, at least until there's enough renewable diesel capacity to meet all of the biomass-based diesel mandate. And that's not something that's going to happen this year, even with the big growth that we're expecting. I think, just off the cuff without looking at it, I think we probably might get there by the end of next year, although it probably would be close, and obviously it will depend on what the what next year's mandates look like. So, but even with that, I still think that the biodiesel guys kind of hang around a little bit next year too, because again, we've got the supplemental 250 million gallon mandate will be added to next year's mandates as well. And so I kind of expect next year to look a little bit like this year, or at least kind of rhyme with this year in terms of the amount of additional renewable diesel or biomass-based diesel production that is needed to fulfill the overall gap in the mandates. For renewable diesel, you can see renewable diesel margins shot up pretty sharply last week. That was due mostly to a big increase in renewable diesel prices. They had kind of fallen the prior week and jumped back above $4 a gallon last week. And on the cost side, we've seen really steady really steady prices for the fats and greases, particularly for most of the fats and greases that we use in our feedstock mix, which again is 50% tallow, 25% DCO, 25% UCO for renewable diesel, and then for biodiesel it's 75% soybean oil and 25% yellow grease. Of those, soybean oils changed a little bit, although prices increased last week, but they were relatively steady towards the end of the week. DCO came down the prior week and a little bit last week, but the other feedstocks have basically been the same price for the last 3 or 4 weeks, which is really, really unusual, to the point where I asked Ryan Standard if I was looking at the wrong prices, or there was a problem with the website or something, and we weren't calculating the weekly averages correctly. And he said that no, those were the prices that we've seen, and that part of the issue, he thought, was probably that we weren't exporting as much. We weren't exporting fats and greases at the same pace that we have been in recent months, because one of the larger foreign producers doesn't seem to be buying from us right now. And so he probably thought that contributed a little bit to it. I think that the other thing is that even though we've got new renewable diesel plants opening up, their first step, or what is happening is the first step in their opening process, is that a lot of them are buying RBD soybean oil, even if they have pre-treatment capabilities. And I think that's because there's a learning curve towards for the pre-treatment process. I say this to a bunch of people: as much as the pre-treatment process is a chemical process, and it in theory should be kind of like the chemistry sets that you used to get as a little kid. And if you put A in and you put B in and then you get C as a reaction, that's not quite that straightforward, and there's a bit of an art to it. And so I think that in order to establish a consistent supply at the beginning of operations, I think that a lot of the renewable diesel producers are relying on RBD soybean oil to make sure that they've got enough supply to run while they're sort of getting up to speed on the pre-treatment process and making sure that the output from the pre-treatment process is going to meet the spec that they need for their process after that. And so I think that ultimately that'll shift as they get comfortable with that, and then you'll probably start to see some of the volatility return to the fat and grease prices. The fact that they haven't moved that long, given the volatility that we've seen in the marketplace, is just, it's odd, and it's frankly it's been really surprising. All of that said, we've got renewable diesel margins coming down a little bit after remaining kind of strong through the summer. That's mostly on a decline in energy prices relative to feedstock costs, because we've got feedstock costs coming down kind of slowly throughout the summer. And so if energy prices are stronger than we expect, if crude oil really does go to $150 instead of $120, diesel prices and gasoline prices go above $5, then renewable diesel probably is going to be a little bit more profitable than we expect. Still, we're expecting more than $3 a gallon, through basically the end of the year, which would be pretty good profits historically for renewable diesel producers, and I would think would encourage the expansion of capacity more than we've seen in the first half of the year. And so instead of having to push renewable diesel plants from sort of the second quarter into the third and the fourth quarter, it may be, especially if renewable diesel producers are making $3 a gallon, it may be that we start to pull renewable diesel producers forward, or new renewable diesel plants forward, from 2023 into 2022, if that's possible, given the constraints of construction and permitting and all of that kind of stuff. All right, so since we're in here anyway, look at our RIN forecast. Generally, it's still the same. Like I said, RIN prices have ran up pretty sharply in anticipation of the EPA release, and so that tended to make the models want to do some wonky things, and we kind of self-corrected them a little bit. We still took their output, at least as far as the relationship between D4 and D6 were concerned. We still expect the spread to narrow, although it's narrowed pretty significantly recently. I think it's gone from, I think it was around $30 in March, and I think we're closer to $16 or $15 now. And so we kind of keep it around that level for the next couple of months, and then tighten it up towards the end of the year down to $10, or maybe a little bit less than $10, before we widen it out again the next year. Another interesting thing here is the models would really like to carry that relatively tight spread into next year, into January. And I think just from a seasonality perspective, and just from a thinking about it logically perspective, in January, the pressure is off on meeting the 2022 RVOs. And so typically what we see then is a little bit of weakness in the spread, because there's not the same concern about the ethanol blend wall that there is, say, in December, and meeting the ethanol mandate, or the overall mandate in December. That said, maybe this year will be a little bit different, because we know already that probably ethanol production is going to be short in 2023 relative to the ethanol mandate, given the 250 million gallon supplemental. And so maybe what will happen is that spread will get tight, and then it will remain tight. And if it does, I think the seasonal decline that we are predicting for RIN prices that occurs at the beginning of the year probably wouldn't occur, and we probably would have steady RIN prices kind of through the year, or at least until concerns about the ethanol blend wall were reduced a little bit. So really not a lot of change here. We're kind of going back and forth between sort of 195 and 190 on D4 prices. That's kind of the range that the model wants to spit out on a weekly basis, and at the peak, and somewhere between $5 and $10 below that for D6 RIN prices. I think that the model might predict prices above $200 for D4 if feedstock prices start to move back up higher. But as you'll see, again, we think that feedstock prices have probably printed their highest number for the year already, given normal weather conditions. And so we think that ultimately limits the upside in the RIN prices. Still, the one other thing that the RIN prices are sort of having to make up for is the LCFS credit price, which now is falling like a rocket re-entering Earth's atmosphere. And we lowered our forecast again this week. We now have a bottom around, I think, $75 by the end of the year, just because we have blown through sort of 115 and 100 as quickly as we had. There was that brief second there where we seemed to pause around 115, and then the market turned and just started to really sink like a rock. And I don't know that, again, I don't know that it's easy to predict exactly how low these prices will go. And so, because we're really in sort of unprecedented territory. And so I think that unfortunately our forecasts going forward are kind of going to be based on, well, how low did the price fall last week? Well, now it's fallen below where we thought the bottom would be, and so we're going to have to lower our forecast again. We still do think that ultimately the bottom sort of, once we hit the bottom and find the bottom, and once the ease of credit generation, or the difficulty of credit generation and ease of deficit generation rises in 2023, and so that gets to be in a little bit more balance, even given sort of the increased shipping volumes to the California market. We do think that prices will start to at least stabilize and recover in 2023. That said, I don't think that there's any scenario that I could see in 2023 other than sort of a big disruption in the renewable diesel industry that shut down a bunch of plants for whatever reason. But I don't think that there's any scenario outside of something just catastrophic like that would suggest that prices will get back to $200 a metric ton anytime in the foreseeable future. All right, let's talk about soybean oil. So you can see our soybean oil forecast, like I said, generally assumes that The highs are in for the year. That's because we have started to, after some delays earlier in the year, we've started to make some significant weekly progress in soybean planting. Basically, the only place where they're still behind the 5-year average is in North Dakota, and that's probably more important for canola than it is for soybeans for obvious reasons. And you can assume that the delays that we're seeing in North Dakota are also occurring in Canada. It's not like we're setting up for a situation like we had last year with the drought. And if anything, the cool weather and the cool and wet weather has probably recharged soil moisture levels to a spot where you can at least say that that if there is a little bit of a drought, or if there's a little dry patch early on in the growing season, that the recharged soil moisture should support yields through that. I don't think that that it's been sufficient to completely eliminate the drought. And in fact, if you look at last week's drought monitor, there were still significant portions of North Dakota that were either in extreme or in the next level down of drought. And so while there's been a big improvement, it hasn't completely eliminated the drought. And that'll be an ongoing concern throughout the growing season, especially since it looks like the forecast models want to start to set up a ridge in the middle of the country near the end of the forecast period. Now, we have gotten a lot of rain in the Midwest. Obviously, that was part of what delayed planting. Although if you really look at it, if you go back and look at the 30-day departure from normal and the 60-day departure from normal for the Midwest, and in particular in Iowa, actually the amount of rain that fell over the last couple of months was below what you would normally expect to fall. And so again, while soil moisture levels have been recharged, it probably is not enough that if we have a big drought, it'll get the plants through and support trendline yields, but it will at least support plants through the beginning of the drought. And I think a lot of people would probably look at a drier and warmer spell, at least for a week or two, as a positive thing for yields for both soybeans and canola and corn, wheat as well. So our forecast is based on the assumption that we will have normal weather throughout the year. If we don't have normal weather, if the ridge that's set up in the forecast models develops into a long-term feature and rainfall is below normal, particularly in the western part of the Corn Belt, then I think these prices will get up and they will go really, really quickly. And our forecast will look a lot different. And we will very quickly shift to projections that have new highs built into our forecast. But that's not where we are today. You can see basically our forecast for all three oils: soybean oil, canola oil is a little bit different, just because we're still dealing with the effects of the drought last year. And so even though crush has been stronger than we might have guessed at this time of the year 3 or 4 months ago, it still is down substantially year over year. And I think we are getting towards the bottom of the inventory. And so winter canola harvest will start here relatively shortly. And you usually get an increase in crushing volumes in June as that winter canola starts to sort of work its way through the system. And that'll be really telling to see if that harvest is sufficient to raise crush enough to keep pressure on canola oil prices. I think that the planting delays probably also mean there were delays in the development of the crop, and so the harvest probably will be a little bit later this year than it typically is, and so maybe that increases a little bit more in July than it is June, but it's something that that we're keeping a very close eye on, and it'll have a pretty significant impact on canola oil prices. The other thing for canola to watch is ultimately the approval of canola, of the pathway for canola for renewable diesel production, and so we still don't think that that's going to be a huge source of demand for canola oil, given the relative expense of canola oil compared to other feedstocks and the relatively poor CI score that canola oil will have relative to other feedstocks, especially UCO and that kind of stuff. But along the West Coast, we do think that it's probably viable. And so we do have some canola oil built into some canola oil demand for renewable diesel built into our balance sheets. But all of that is probably going to be something that is much more of a feature in the next marketing year than this year, just because of the relatively tight supplies. And because of all of that, we think that there still is potential upside in canola oil. And so that's the one that looks different. If you look at palm oil looks different. We do get the Malaysian Palm Oil Board report again this week, this Friday. Expectations are for a relatively small decrease in ending stocks, about 5% or so, based on a big increase in exports due to the Indonesian ban on exports that lasted for a couple of weeks in May, and an unseasonal decrease in production. I think going forward, probably traders will focus on Malaysian production as much as they will on Indonesian exports. I mean, I think both of those things are going to be relatively important in the next month to 6 weeks at the very least. Malaysia has struggled with getting enough migrant workers into harvest, and so that's why you see the month-over-month decline in production for this month. They've got some programs that are going to try to address that, and they're going to try to get production back up based on an increase in the visas that are in a more efficient visa approval process, I guess, that would make labor more available. But that's something that they've been trying to do for a while now, since last fall at the very least. And the fact that they're still having problems with labor, and that's bleeding into unseasonal declines in production, suggests that that could be a problem for longer than expected. And either way, we expect that Malaysian palm oil stocks probably remain relatively tight around this level, around 1.5 million tons, somewhere in there, through the end of the marketing year. And so that will support palm oil prices, but it won't necessarily drive, it's not tight enough to necessarily drive palm oil prices to new highs. Again, for palm oil, just like with soybean oil, if there's any disruption in world vegetable oil supplies anywhere, then very quickly the forecast will change to one that features new record prices and a line that goes up and to the right instead of down and to the right. Okay, with that, there are some questions. So let me stop this and open up the questions. Are RBD premiums on canola as high as soybean RBD right now? Uh, that is a really tough one to figure out because it's very hard to get crude canola price quotes. It's very hard to get canola price quotes in canola oil price quotes in general, but it's particularly hard to get crude canola price quotes. I would assume that that RBD canola price, the refining margin for canola is probably similar to soybean oil relative to its history, and just because of the high demand for RBD vegetable oils period right now. There is stronger demand for RBD soybean oil because of the what we were talking about before, because of the fact that new renewable diesel producers are using RBD soybean oil as opposed to crude soybean oil. So maybe the refining margin for soybean oil is a little bit higher relative to its historical level than canola is. But I would think that the shortfall in canola seed production and the fact that crush really has to compete pretty heavily with the export market would mean that the RBD premiums would probably need to be pretty substantial to get the seed to go to the crusher as opposed to the export market, particularly since for canola, the canola oil represents a significantly larger portion of the overall value of the crush than it does for soybean oil. Why are you forecasting choice white grease and BFT to fall dramatically in Q4? Those are a reflection in part on the overall decline in feedstock prices. And so the way that we forecast prices is we look at the fundamentals for each individual commodity. And then once we've done that and forecast prices based on that, we look at the spreads to other commodities. So then we look at the spreads between the fats and greases, and then we look at the spreads between fats and greases to vegetable oils. And so if you'll notice in our vegetable oil forecast, you can see that for soybean oil, we've got I guess steady to a little bit lower in Q4. I think by the end of Q4, we've got prices coming down pretty strongly. And I think that is what's translating into the weakness in prices in CWG and BFT. If you look at the relationships between all of those, they all seem to fit together, at least from that perspective. And so again, that is kind of the final check that we do on everything. And so even though it may be that the models want to predict CWG or BFT or UCO or any of the other prices potentially higher than what ends up in the final forecast, we really do try to stick to the trend in the spreads as a check on sanity for the models, because the models will sometimes tend to sort of run off on, they'll pick something up and they'll start to run with it, and you get some prices that just don't make sense at all. You'll get UCO prices that are way out of whack relative to the other fats and greases, or fats and grease prices that are way out of whack relative to soybean oil. Now, I know that that those relationships have changed over the last 18 months or so, and we do try to adjust the spreads both from the so that they're in line with the historical trend and with the recent trend. And there's a couple that have, and I can't think of them right now without the spreadsheet in front of me. There's a couple that have sort of flipped where, and this is just for example, and I probably will get this entirely wrong, but DCO may have been premium to BFT, and now BFT is premium to DCO. There's a couple of things that have sort of flipped like that in the past 6 months or so. And so in those cases, what we do is we go in and we try and look and figure out if there's a reason for that we think is going to be ongoing, or if it's just if it's just sort of a quirk in the market where maybe for a month there were a lot of orders for one particular commodity that we don't necessarily think are going to repeat in the future. And then we sort of try and make the spreads conform to whichever one of those scenarios we think fits better. But in general, when you see prices that you think probably don't make sense, one, please ask during during the webinars. That's exactly what these are for. But two, try and think about how things are priced relative to each other and see if that makes sense to you. And then if that doesn't make sense to you, then also please ask in the webinar, but then also please follow up with me with an email, and we can get on the phone and discuss it in more detail, because I'm always happy to have feedback on price forecasts or any of the other numbers that you see on the website or anything that I say on this call. All right, one more. What is your thought on plants increasing production in the last half of this year due to no clear guidance on the tax credit expiration at the end of the year being extended? I think it'll be interesting in this way. I think historically, what we've seen is that the tax credit has not been extended, and it doesn't necessarily have a big impact on production because the industry assumes that it's going to be extended at some point. And Congress has fed into that behavior by letting the credit lapse and then retroactively extending it on multiple occasions. Now, the last time that happened, the credit had expired for 2 or 3 years, I think 2 years at the very least. And we started to do surveys to try and establish a price for the credit, so that we could include that in our gross margin calculations. And what we found was that that the credit still traded at about, it varied depending on the day and in the headline in the news, but it varied from 75 cents to 30 cents to as low as 30 cents. And there were always people that were willing to sort of buy and sell at those levels, no matter what the survey said. There was always people that are willing to buy, or that are willing to provide liquidity at the extremes in any market that trades. And so I think that even if it does expire, it doesn't necessarily mean that that the value goes away, unless it expires and there's an explicit statement from Congress that says we're never going to renew this again, and they really convince the industry that that they're not going to renew the credit again. I think that statement would really have to be, it would have to be very credible for the industry to believe it, again, given the fact that over multiple years, Congress has trained the industry to expect a retroactive extension after the credit has expired. This time it'll be perhaps a little bit different because you have the new renewable diesel plants that are coming online, and may not have the same experience that the rest of the industry has with the blender's tax credit, and so maybe it will have a bigger impact this time than it has historically, just because of that fact, um, just because those some of the new players may take the government at its word and say, okay, well, the tax credit has expired. The only thing that I would say that would to sort of offset that is that the credits, I think, will still trade with some fraction of the value even after they expire. And so there will still be some incentive there to produce based on that value, even if it's not really there officially. I personally think that I think that it will, I guess I've been as trained as well as the rest of the industry to think that ultimately they will extend the credit. I think that they probably will start to phase it out a little bit more than they have, or at least make more noise about phasing it out more than they have in the past. And so I would expect it to be extended for another couple of years, maybe at 75 cents, and then another couple of years, maybe at 50 cents, and then maybe 50 cents sort of out through the end of the next 10 years or something. And in fact, that's kind of the assumption that we have built into our long-term forecasts. So I think that there could be a little bit less incentive for production from that perspective. If that happens, then maybe biodiesel production is a little bit the rationalization of biodiesel capacity is a little faster than we expect. I don't, again, because I think that it will trade with some fraction of the value. I don't know that, and because the industry's been trained so well, I don't know that I think that that'll be a huge factor, especially if it's going to be renewed at a value less than $1. But that is it's a great question. It's going to be something that's going to be interesting. If it does expire and we don't have if it does expire, we will start to survey again to try to establish a value for it, and you will be able to see the value on the website in the credit breakdown. So, and we'll probably talk about it every week, and we'll probably start to forecast what we think that value is too, is based on what we think is ultimately going to happen with the credit. The Jacobson forecast shows animal fats peaking in October, while SVO forecast steadily depreciates. It seems the two forecasts are disconnected. Do you expect animal fats will fall at a similar rate? There usually is some, it usually works the opposite way. So there usually is a lag in the soybean oil sort of moves first, and then you get the move in animal fats, and kind of 6 weeks later you start to see animal fats either move higher or lower following a move in soybean oil. I think probably what's happening in the fall forecast now is there's probably some relatively strong seasonal impact in one of the fats that is taking the whole fats complex down because of the way that we look at the spreads. So the fact that I've gotten a couple of questions about it, and the fact that that there does appear to be that disconnect, because I would assume that it would kind of go the opposite way. I'll take a look at that, and and I'll talk a little bit about it next week. Next week we'll do fats and greases, and so maybe that's what we'll talk about a little bit more next week. And maybe what we'll do is we'll go into a little bit more about how we forecast fat and grease prices next week. But what I would assume in terms of that disconnect right now is again, there probably is there's probably a strong seasonal tendency in one of the fats and greases, or there's an odd build in inventories or something like that that is causing that price to move lower, and then to balance the spreads, the other prices are following it. That's my guess what's happening. But again, let me look into that, and then we will talk about that in some more detail next week, because we're well over time this week. All right. Thank you everybody for showing up, and I will see you all next week. If you have any questions, always please feel free to email. Otherwise, have a great week, and I will see you next Tuesday.